What if I told you that everything you've been taught about investing is wrong? You don't need thousands of dollars, years of experience, or a background in finance to get started? What if I told you that the single biggest barrier to building wealth isn't money, but mindset? For decades, people have believed that investing is only for the wealthy. We picture Wall Street brokers in suits, millionaires trading in skyscrapers, or families with trust funds. Ordinary people are taught to believe investing is out of reach, that we should work, save, and maybe one day, if we're lucky, we'll have enough to put into the stock market. But here's the truth. Waiting until you're rich to invest is the reason many people never get rich. The myth goes like this. I'll start investing when I have $1,000 saved. I'll wait until I have extra money, then I'll think about stocks. Investing is too risky for me right now, and yet years go by. A perfect moment never comes. Bills pile up, emergencies happen, and the dream of investing fades into the background. But here's what separates those who build wealth from those who dante. They start before they re-ready. Think of Warren Buffett, one of the richest men alive. He didn't start by investing billions. He bought his first stock at just 11 years old with a tiny amount of money. Many of today's successful investors began with less than $100. The difference wasn't the size of their first investment. It was the fact that they started early. Now here's the good news. In 2025, starting has never been easier. Thanks to technology, apps, and fractional investing. You can begin with as little as $1. That means your first $50 isn't just enough. It's powerful. So let's break the myth once and for all. You don't need to be rich to invest. You need to invest to become rich. Now, you might be asking, okay, but come on, can $50 really do? Let's do the math together. Imagine you invest $50 a month into a simple index fund. Let us say the S&P 500, which historically grows around 7 to 10% per year. After 20 years, you wouldn't just have the money you put in. That's the power of compounding. Your money makes money, and then that money makes even more money. Think about planting a seed. Single seed doesn't look like much, but if you water it, give it sunlight, and protect it, over time it grows into a tree. That tree produces fruit, and inside each fruit are more seeds capable of growing more trees. That's exactly how compounding works. Your first $50 is the seed. The longer it grows, the bigger the forest becomes. Now let's push the numbers further. What if instead of $50 a month, you started with just $50 once and never added another dollar? Over 30 years, that single $50 could grow to around $400 at a 7% annual return. Not life-changing, but proof that growth happens even with tiny amounts. But now imagine you keep going, $50 every single month, consistently, for 30 years. That becomes over $56,000. And if you can push it to $100 a month, suddenly we're talking six figures. $112,000 plus from small regular investments. The point is clear. It's not about the size of your first investment. It's about building the habit of investing. $50 is enough because it gets you started. It teaches you discipline. It creates momentum. Here's another way to think about it. Every month, most of us spend $50 without even realizing it. A few coffees, a streaming subscription, one night of takeout, that money disappears forever. But if you redirected just $50 a month into investing, you'd be buying something that grows instead of something that fades away. So yes, $50 is more than enough, because it's not just about the money. It's about proving to yourself that you can start. Before we dive into the exact steps, let's lay a foundation. To invest with confidence, you need to understand the basics. Don't worry, I'll keep this simple. No jargon, no complicated theories. Number 1, stocks. When you buy a stock, you're buying a piece of a company. If the company grows, the value of your stock grows too. For example, if you buy one share of Apple, you own a tiny piece of Apple. If Apple makes more profit, your piece becomes more valuable. Number 2, ETFs, exchange-traded funds. An ETF is like a basket of stocks. Instead of buying one company, you buy many at once. This spreads your risk. Imagine you buy a tech ETF. Inside that basket, you might own pieces of Apple, Microsoft, Google, and Tesla, all at the same time. If one company struggles, the others balance it out. Number 3, index funds. An index fund is a special kind of ETF that tracks the overall market. For example, the S&P 500 index fund owns 500 of the biggest companies in the US historically. The S&P 500 has gone up about 10% per year on average. That's why it's considered one of the safest and smartest places for beginners to invest. Number 4. Bonds. Bonds are like loans you give to governments or companies. They promise to pay you back with interest. They're safer, but grow slower. Number 5. Compound interest. This is the magic formula of wealth. When you invest, you earn returns. Those returns get reinvested, and now you earn returns on your returns. Over time, this snowballs into massive growth. Albert Einstein once called compounding the eighth wonder of the world. Number 6. Diversification. This simply means don't put all your eggs in one basket. If you invest all $50 into one risky stock and it crashes, you lose everything. But if you spread that $50 across many companies, industries, or even countries, your risk drops dramatically. Number 7. Risk versus reward. Investing always carries risk. Stocks go up and down. But historically, the stock market always rises in the long run. The key is to avoid chasing quick wins and focus on steady growth. So here's what we've learned so far. You don't need thousands to start investing, just $50. Compounding can turn small amounts into big results over time. The basics of investing aren't as scary as they sound. Stocks, ETFs, and index funds are tools anyone can use. And now that we've built this foundation, it's time to get practical. I'll show you the exact step-by-step action plan. How to open your first account, where to invest your $50, and how to avoid the biggest mistakes beginners make. Okay, so now you understand the myths, the power of $50, and the basics of investing. But let's get practical. How do you actually take your first $50 and turn it into your very first investment? Don't worry, I'll walk you through this step by step. Step 1. Choose the right app or broker in 2025. The world of investing has become easier than ever. No more complicated forms, no more giant fees. Instead, you have beginner-friendly apps that allow you to invest with as little as $1. Some of the most popular options are Fidelity, known for reliability and zero fees. Vanguard, great for index funds. Robinhood, simple interface, fractional shares. Webull, for those who want more research tools. Acorns, invests your spare change automatically. The key things to look for: zero account minimums, that ability to buy fractional shares, low or no fees, simple mobile experience. Pick one that feels right for you. For most beginners, simplicity beats advanced features. Step 2. Open your account. It sounds intimidating, but it's just like opening a bank account. You'll fill out your name, social security number, address, and a few questions about your financial goals. This usually takes 10 to 15 minutes. Step 3. Transfer your first $50. Here's the part where you actually commit. Link your bank account and deposit $50. Don't wait until you have more. The most important investment you'll ever make is this first one. Step 4. Decide where to invest. Here's the exciting part. What do you actually buy with your $50? For beginners, I recommend simple, safe ETFs. Vanguard S&P 500 ETF gives you ownership in the 500 largest U.S. companies. VTI, Total Stock Market ETF, owns thousands of companies, giving you massive diversification. QQQ Tech ETF focuses on big tech companies like Apple, Microsoft, and Tesla. Even with just $50, you can buy a fractional share. That means you don't need $400 for a full share of Tesla. You can buy $10 worth. Step 5. Make the purchase. Click Buy, enter the amount, and confirm. That's it. You are now officially an investor. It might not feel dramatic, but you've just crossed a line most people never cross. Step 6. Automate your habit. The secret to building wealth isn't just investing once. It's investing consistently. Most apps allow you to set up automatic deposits. So set $50 to go in every month on autopilot. Over time, you won't even notice it leaving your account. but you will definitely notice it growing in your portfolio. And there you have it. In just a few simple steps, you've gone from someone who thought investing was impossible to someone who's officially building wealth with just $50. Now, let's talk about something equally important: what not to do. The truth is, many beginners lose money not because investing is too hard, but because they make emotional, avoidable mistakes. Mistake 1. Chasing hype. We've all seen it. A new stock, a new crypto, or a new hot investment suddenly explodes in popularity. Everyone online is talking about how it's the next big thing. Feels like if you don't jump in, you'll miss out. But here's the problem. By the time the masses hear about a hot stock, the big money has already been made. Many beginners buy in at the top, and when the hype fades, they're left with losses. Mistake 2. Day trading without experience. Day trading looks glamorous. Buy low in the morning, sell high in the afternoon. But the truth? Over 90% of day traders lose money. They're playing a short-term game against professionals, algorithms, and institutions with billions of dollars. Unless you're prepared to study for years, don't gamble your $50 by trying to time every tick of the market. Mistake 3. Panicking during market drops. The stock market never moves in a straight line. It rises, it falls, it corrects. Sometimes it crashes. Many beginners make the mistake of panicking when their investment drops by 10% or 20%. They sell in fear, locking in their losses. But here's the secret. Historically, the market has always recovered. Every crash in history has eventually been followed by new highs. Selling in panic means you miss the rebound. Mistake for investing money you can't afford to lose. This is important. Your $50 should be extra money, not rent money. If you invest money you need immediately, you'll be stressed, emotional, and more likely to sell at the wrong time. Always build an emergency fund first, then invest money you can leave untouched for years. The key lesson? Don't try to get rich quick. Focus on staying invested, avoiding hype, and trusting the process. Now let's talk about the real magic. Not just investing $50 once, but making it a consistent habit. Think about exercise. One workout doesn't transform your body. But if you exercise 3 times a week for a year, the results are undeniable. Investing works the same way. The power of consistency. If you invest $50 every month for 10 years at 8% average returns, you'll have around $9,000. Keep going for 20 years, and that becomes almost $29,000. Push it to 30 years, and you're looking at $67,000. It's not about hitting home runs. It's about showing up month after month. Automating the process. The easiest way to stay consistent is automation. Most apps allow you to set an automatic transfer. Set it once and forget it. Your $50 will quietly invest every month, no matter what. Growing the habit. Start small with $50. Once you're comfortable, increase it. Maybe $75, maybe $100. Each raise at work, each side hustle, each little extra can be redirected into your investments. Before you know it, you're not just dabbling, you're building real wealth. So remember, don't underestimate $50. It's not about the amount, it's about the habit. Let's wrap this up with a dose of truth. Most people will never invest. They'll make excuses. I don't have enough money, I'll start later. It's too risky. And years later, they'll look back with regret, realizing that if they had just started with $50, they could have built something incredible, but not you. By watching this video, by learning, by deciding to take action, you've already separated yourself from the majority. Wealth isn't built on luck. It's built on 3 simple ingredients. Starting small, staying consistent, giving it time. That's it. $50 isn't small. It's powerful because it's your starting point. So here's my challenge to you. Don't just watch this video. Take action today. Open an account. Transfer $50 by your first ETF. It may not seem like much now, but 10 years from today, you'll look back and realize this was the moment that changed everything. Remember, financial freedom isn't about being born rich. It's about the decisions you make, the habits you build, and the courage to start. So let's do this together. Drop a comment below. What is the first thing you'll invest your $50 into? Let's inspire each other, let's grow together, and let's prove that wealth is possible for anyone willing to begin. And as always, this is Budget and Beyond reminding you, save smart, invest smarter, live better.